Hi everyone, welcome to Vantage webinar for today. Right, so for those of you guys who are here with us, I'll just wait for about 1 to 2 more minutes for more people to join us before we get the session started. So for today, we will be covering on price action trading. We'll be showing examples as to how we combine concepts like order flow, market structure, and understanding demand supply zones, and how we can put them all together and come up with a trade strategy. So if you guys have any questions along the way as well, right, please don't hesitate to put them under the questions chat. Okay, so I have the questions chat open as well. So if you have any questions, feel free to put them there. Okay, let's get the session started. Right, so for those of you guys who just joined us, a very warm welcome. So for today, we are covering on price action trading. So just a quick introduction of myself. I'm Lee Sing. I provide FX advisory to institutional clients. I'm also part of the team that's recognized by the Technical Analyst Awards as finalist for the best FX research. If you guys are currently watching this with us live right now, right, if you have any questions, feel free to put them under the questions chat. If not, you can reach out to me on LinkedIn as well. So just a quick disclaimer before we get the session started. The information presented here, it's not to be treated as investment advice. It's for informational purposes only. Okay, so this is the agenda that we will be covering for today, right? So this will be a 30-minute session. So first we will cover on market structure. So learning how we can combine market structure across different time frames. We will also look at supply and demand zones, right? So essentially how we can identify them and how we can use them to determine our entry stop losses as well as take profit targets. We will also look at the interaction between demand and supply and understanding that when price comes into a demand area, for example, right, and it fails that demand area, then conversely, it creates a supply zone. Okay, so will be the general concept that we'll be exploring as well. And then finally, we'll move on to risk and trade management concept, right? So covering a little bit more on risk and trade management in terms of partial profits and also when we shift our stop loss to break even. So a lot of this is actually dependent on your individual or your preference as well. But I'll just share a bit more on when will I usually shift to break even and where are the potential profit targets and also what is the percentage of the profits that I'll usually take. Okay, so before we hop on to looking at the trade strategies and chart examples, right? Let's just do a brief summary of the market structure first, right? So this is for those of you guys who are not familiar with market structure. Generally, you can categorize the market in three different categories. So the first one, it's when market is in an uptrend. So you can see that in an uptrend, you have successive higher lows and higher highs being formed. So take a look at this example that we have, right? So the one on the left, this picture, it's one that it's drawn in a line chart. So essentially, when you load any trading view chart, right, at one glance, you should be able to see the general direction of the market. So this in this example, right, in an uptrend, we should see successive higher lows and higher highs being formed. And this is an example of how you can see it on a chart, right? So this is an example of it on the right. So the one that we are seeing over here. So one thing to note in an uptrend is that you can see that the highs themselves don't hold, right? So they're constantly being run, whereas the low themselves are the ones that are constantly holding. So the general assumption is that when you open up any chart and you see that prices are in an uptrend, this uptrend will continue, right? So the trend is likely to hold and it's going to continue, which also means that any pullback itself on the smaller time frame, if there are confirmation, could present opportunities for us to buy, targeting this high here. So the most important thing about identifying these market structures and looking at uptrends, downtrends, and ranging markets, it's understanding the general assumption that in an uptrend, right, or in a downtrend for that matter, right, trends are going to hold unless otherwise, right? So unless there is a change in structure, we're expecting price to continue to form higher lows and higher highs. So that's the assumption going into these moves. You can also see one more thing to note here. It's that the highs, right? So as I've mentioned, the highs themselves are weak and these highs are constantly run, right? So you can see that they are constantly being broken. whereas the lows themselves in an uptrend, these lows should not be violated. So if you have a case where prices break below this low that we have over here, right, we can consider this a change in structure and a potential reversal. So potential change in the uptrend, right, possibly shifting to a downtrend. Okay, so this is for an uptrend. Now let's take a look at a downtrend. So in a downtrend, right, how do you classify that a market is in a downtrend, right? So for one, we look at the highs and lows. You can see that for the highs themselves, you have successive lower lows being formed as well as lower highs. So the highs are marked out in blue, these blue dots that we have over here, and the lows are marked out in gray. So again, if you're to load any trading view chart, right, just at a glance, you can see the general direction of the market. So this is an example of a chart. I believe this is on euro dollar, right? You can see essentially the highs and lows, the general direction of this moves. So again, right, in a downtrend itself, you see that these highs themselves should hold. They should not be violated, whereas the lows are the ones that are constantly being run. So they're constantly being broken. So what this also means is that in a downtrend, right, if you see that prices are approaching this lows itself, understand that these lows themselves are generally weak because it fails to break any structure. And this move that we're seeing over here is just a pullback before price continue in its downtrend. Okay, so that's the general understanding of trend, right? And also the assumption going into these areas. Even though market structure itself, right, if you take a look at the theory, it seems very simple to understand, right? It's very straightforward, but it's actually useful in combining this, right? Because it helps us to determine order flow. So when you take a look at market structure, right, in a downtrend, again, the assumption is that prices should continue forming your lower lows and lower highs. Any pullback within this zone, especially when price comes into a resistance area on the higher time frame, we are expecting price to continue on the downside. Of course, with this assumption, right, you need to look for confirmation on the smaller time frame. So if there's no confirmation on the smaller time frame, there's always a chance that price could continue higher to break the structure. Okay, so we trade according to what the market tells us, right? So when price comes into a specific resistance area in a downtrend, we are not taking immediate shots. Rather, we're waiting for price to enter into this zone with confirmation on the smaller time frame. So we will take a look at specific examples later on. So now that we have identified the downtrend, the uptrends, as well as let me just clear this in a moment, right? So the next one that we will be looking at would be for ranging markets. So in ranging markets in general, right, this is when you can see that there isn't a clear movement. You don't see clear movements, right? So resistance and support levels that we see over here are being respected. So what this also means is that markets are generally moving sideways, right? So unlike a clear uptrend or clear downtrend, right? In this example, you can see that the horizontal levels in terms of the resistance and support levels are being respected. So how we can play this, right, is to wait for a breakout below the trading range for confirmation. So this would be a breakout confirmation. A break to the downside would signal more downwards move. A break to the upside could signal more upwards move. Okay, so this would be a breakout. It will be more related to breakout strategy, right? So the idea is to identify a range, right? So you can either straddle, which is basically selling when price enters a resistance and buying when it enters a support. This is especially useful when there isn't a clear direction. So if your markets are trading sideways, then this would hold. But in a strong trending market, right, in an uptrend, for example, when price consolidate, knowing that this high itself in an uptrend, the highs are weak. What this also suggests in an uptrend is that we should wait for the break of the upside, right? Retest before it continue playing the move up. Okay, so that it's a brief summary of ranging markets, uptrends and downtrends, and also what are the basic assumptions behind them. Okay, so when I covered this three categories, right, I've also briefly mentioned on the highs and lows, right? So understanding the idea of weak highs and strong highs. Basically, the concept behind this is just looking at this area. So let's say if you're in an uptrend, right, generally because the lows are the ones that are holding, right? So you see that the lows are not violated, whereas the highs themselves are constantly being broken, right? So in an uptrend, if you see a resistance area, what's going to likely happen, right, in an uptrend is that price would break above the resistance area and continue moving higher. So this is why in an uptrend, the highs themselves can be considered weak highs because these highs themselves are constantly being targeted. So you can see that these highs don't hold, right? The resistance areas don't hold. The support levels, however, right, should not be violated. So these lows themselves are strong. What this also means, or what this implies, is that when price breaks below this low, right, then we can consider this a change in structure. Okay, so this would be the first concept on understanding strong highs and lows, weak highs and lows. The idea why we need to be clear with this is that this area, this concept itself would give us an idea as to where we can target the trades. So where can our take profit target be, right? And also help us to understand order flow, essentially. The second concept that we would like to cover, it's more on the fractal nature of markets. So what this means is that across different time frames, you can see that prices act similarly in different time periods. So in an uptrend again, right? So let's use the same example. In an uptrend, you can see that on the smaller time frame. So before we see this reversal for another push up, right? So let's say price comes into a support area and we see that reversal and price pushed higher. Before we see this on, let's say, the 1 hour picture, we will first see the reversal on a smaller time frame. So maybe on the 5 minutes or even the 15 minutes. So this is what fractal nature of market means, and how we can actually use this concept. It's basically waiting for the smaller time frame, right? So looking at reversal on the smaller time frame in order to confirm the move on the higher time frame. So again, right, if you're not clear as to what I'm trying to say here, right, don't worry. We will go into specific examples on the charts later. So this is just the concept behind it, right? Understanding what's the main idea behind these concepts. So because of the fractal nature of markets, this is where we will take a look at the reversal on the higher time frame, right? So this reversal on the higher time frame, as we've mentioned over here, right? Before we see this strong move up, a continuation of the uptrend, we will first see this reversal, right? When price comes into a support area, we'll first see this reversal on the smaller picture. So this can be the 5 minutes, the 15 minutes, 10 minutes, 30 minutes, right? So the idea is basically moving down from a smaller time frame. So let's say if you're using a 1 hour here, then in this case, you can monitor this reversal, let's say on the 5 minutes or even the 15 minutes. So depending on which market structure is clearer, right? So this one would have to be depending on the setup. And then the last concept that we have, it's looking at the interaction between demand and supply zones, right? So in demand and supply zones in general, understand that when supply zones, right? So when price comes into a supply area and it pushes lower, right? So when price interact with a supply region, failed it and pushed higher, what this creates, conversely, it's a demand area. So the interaction of supply and demand areas would tell us, right? So you can see basically the tug of war between your buyers and sellers. So supply zones, when they fail, it creates demand region and vice versa. Okay, I have a question, right? Okay, sorry for missing your question, Musonda. Right, so what confirmation can you look on this lower time frame? So generally on the lower time frame, look for a change in structure, right? So we will take a look at the example on, I think this is on gold, right? So look for change in structure. You can take a look at basically, so when in terms of change in structure, what I mean by this is that when price comes into a supply region, you can see that coming into this area, if we're expecting a reversal on the lower time frame, you need to wait for a break of the previous low, a retest before it continues to the downside. So I will go on to a specific example for this, right? I have another question by Chong, right? So I wonder if it can be a simplified version of the know-how to distinguish accumulation versus distribution, since both are consolidation. Maybe if you don't mind answering on the example on pound dollar. Yes, I believe it's the same thing, right? So the idea is that they have different terms attached to it, but it's the same idea. So when buyers or when supply fails, then it creates demand and vice versa. Okay, so we will take a look at these examples later, right? So let me just clear all these drawings and let's see where we are here. Okay, so okay, let me see. Yeah, so we have market structure, right? So I'll move on to this slide first before I hop on to the examples, right? So we'll take a look at pound dollar as an example. We will also take a look at Aussie dollar as well as Euro dollar and gold as well. So we have quite a few examples that we can apply these concepts. Okay, so the next one, the next concept that we want to look at, it's more of identifying supply and demand areas, right? So this will be useful in terms of helping us to identify our entries, stop losses, and take profit targets. So the idea behind this is basically identifying specific candles where price came in, interacted with the zone, and then at the same time, it either fails the zone or continue in the direction of the trend. So in terms of how do we identify these candles, right? How do we identify these zones themselves? You can see that this can actually be found. So there are a few ways we can find this, right? So one of them would be through these extreme movements. So when prices are forming a change in structure, you want to identify the last candle, basically the candle itself this extreme move, right, or the extreme of this move itself is the one that caused the change or the break in structure. So this is one way you can identify the demand. Another way you can look at it, it's looking at the moves themselves. So let's say within this region, you can see that sometimes, right? So for this example, I'll show this example on euro dollar, but the idea is that within the moves themselves, you can see that sometimes there's hesitation or there is that interaction that we're looking at. And this is especially obvious on higher time frames. So we'll take a look at this example, right? So maybe before I move on to the second and third point, right, let's just take a look at euro dollar as an example. So if you take a look at euro dollar as an example, let me just clear these drawings. So you can see in this region, right? So this is for the benefit of those who didn't attend yesterday's session. So you can see basically for in terms of supply and demand areas, maybe just a quick summary of that, right? So in general, you can see that what we're trying to look out for here, especially on the higher time frame, is the extreme of this move. So you can see that if I were to paint out this structure, you can see this is the last move, right? And essentially this is on a weekly time frame, which means that one candle itself represents the movement on the weekly picture. So what this also shows is that you can see that this is basically the last high. And just remove the magnet mode. So this is the last high that caused the break in the structure. So we can see that we have a parallel downtrend, right? Lower lows and lower highs being formed. So in terms of the assumption here, it's that prices would continue on a downtrend over here, right? As long as prices are holding below this low. So that's the idea. So you can see that when price pulls back into this region, so because this is the last move that caused the break in structure, recall that I said the extreme of this candle itself would serve as the supply region. So if you take a look at this, right, you can see that this is the supply region that we have here. So I'll just highlight this area. So you can see that this is the supply that we have. And notice how price interacted with the supply. So I'll just remove this. I mean, not remove it, but extend this, right, to where the supply region is. So you can see that coming into this area itself, right, notice the first time price came in to tap the supply region over here, and then again over here. So you can see that when price came and tapped the supply region the first time, we saw this rejection, right? So price pushed lower, so it acknowledges the supply region the first time here. And then what happens is that it then creates a new supply region. So you can see that the candle that still held within the high of this area, this horizontal line, this is the last high that came and tapped into the supply region. You can see that the candle that's still held within is this candle, right? This is the candle that's the last candle that still holds within the supply region before we saw a strong break above it. So when price broke above the supply, then this is when we use the concept. So recall this concept where we say that when supply fails, it creates demand. So this idea that we have over here. So the interaction of supply and demand area, when supply fails, it creates demand region. So you can see this, how this is applied on this area here. We have this, right? This is the higher time frame supply. Price came in, tapped into the supply, created a new supply region that we have over here. And you can see that when this, so price, essentially, this is the last candle that held within it before it pushes higher. So you can see that when supply, which is this supply, when this supply fails, it creates demand. So this is the demand area. Okay, so far, so good. Okay, so when price creates a demand, right? Let me just remove this drawing. Okay, so when price comes into this region, you can see that once again, right, price came in and tapped into the demand area. So this is the setup that you want to look at. Basically, what you're trying to find here is a resistance area or a supply zone and a demand area where we have prices testing both of this region. So prices basically push higher up into the supply and then back down into the demand. This is also what you can call consolidation, right? So essentially prices are going nowhere. It's moving, it's respecting both the supply and demand area. Now, the interesting part comes in how do we determine the order flow here? So in order to determine the order flow, we need to see which are the areas that are being respected, right? So I need to check whether the demand area is going to hold, because if demand hold, what this tells me, so this would be on the concept of strong highs and weak highs, right? So recall the concept that we covered here. This one. The first point, right, on weak highs and strong highs. So the idea is that if the high itself fails to break the demand region or it fails to break the low, then this high itself becomes weak and it is a potential target. Okay, so once again, right, if this high breaks, it pushes price into a demand area, and you can see on the smaller time frame that demand is starting to gain control. What this shows you is that this high itself, it's weak, and hence it's a potential target. what it also implies is that you can take long positions from the bottom as long as demand starts gaining control, targeting the high that we have here. So if you take a look at the euro dollar example, you can see that this is exactly what it's happening here, right? So price came into a demand area. We need to check on the smaller time frame if this demand is going to be in control. If it is in control on the smaller time frame, what this shows us is that this high that push price into the demand area, this high itself, it's weak. Hence, we can take a long position targeting this high. Okay, so this, it's on the, you can call it different terms, right? You can see that prices are basically consolidating, but that's the key idea, basically understanding that when this high itself push price into a demand area, you need to look for the smaller time frames confirmation. Because how do I know if this demand area is going to hold? I know that this demand area, it's likely to hold because on the smaller time frame, it's showing me signs of reversals. So if you take a look at this, just focus on this portion of the chart. And let me remove all this unnecessary drawings. So more came. There we go. Okay, so I'll just mark out the weekly high. And let me just remove this. Okay, so I'll mark out the weekly high and we will go down to the smaller time frame and essentially focus on this portion of the chart. So let me just mark out this high, right? So this is the high that we need to check whether it's going to be taken or not. So this is the weekly high. So you can see when price comes into a demand area over here, right, which is basically this area, right? So this is the chart that we want to focus on, this portion of the chart here. So again, you can go down to the smaller time frame. We are on the weekly picture right now, so you can go down to the 4 hours or even as tight as the 15 minutes. So the idea is that you can see over here, right? So nothing much on the 4 hours. Prices are still, it came into the region, the demand area, basically, which is this portion. You can see that price came in, tapped into the demand area on the daily, which is this gray zone. And what we're trying to check over here is that we want to find, again, smaller time frame reversal, because if smaller time frames start respecting this areas, right, it start respecting the demand area, you see the reversal in terms of a change in structure. What this suggests is that this high itself would be a target, this high that we have that drove price into the demand. Okay, so let me just put this marker here. And then again, we go down to the 5 minutes or even the 15 minutes time frame. You can see this clearly as well, even on a 15 minutes time frame. So just now, one of you guys, right? So Musunda asked me, what kind of confirmation are you looking at on the lower time frame? So if you take a look at the lower time frame, recall the market structure. So again, this would be using the concept of lower lows and lower highs. In a downtrend coming into this area, right? You can see that we have prices forming a downtrend, para. You can see lower lows and lower highs, right? So if I have to paint out the structure, you can see that this is essentially the last low. So recall the assumption that we said, right? If we want price to continue on a downtrend, what should continue is that prices should continue forming your lower lows and lower highs. But in this example, you can see that this is the last high that we have. So the change in structure would come when price breaks above the last high. So you can see that this is basically the last high. So mark out this region. And the break in structure comes when price breaks and close above this region, which is essentially this move over here. So this is the first confirmation that demand, it's gaining control, right? And what this also means is that on the higher time frame, so recall that we mark out the weekly time frame, right? So it also means that this weekly high that pushed demand into the that pushed price into the demand region itself, this high is now weak and it's a targeted high. So what it also means is that we can play long positions targeting this high. Okay, and the reason why we can do that, it's because of the confirmation on a smaller time frame. So if prices did not have this break in structure, if it continued to the downside with your lower lows and lower highs, you can see that over here, right, in this example itself, without this confirmation, it doesn't tell us that this demand area is going to hold. This gray zone that we have here. So in order to check whether this demand area is going to hold, you need this confirmation on the smaller time frame to tell you that now supply regions are starting to fail, demand is in control, and you can target this weekly high. Okay, so that's basically how you can combine all these different concepts, right? Looking at the fractal nature of markets, reversal on the smaller time frame, and more importantly, the interaction between demand and supply. You see this example with interaction of demand and supply, right? This one specifically on the higher time frame, the weekly region. Okay, so let's take a look at another example, right? So yesterday we covered on Aussie dollar on a 4 hours time frame. So I won't go into deeper details on this, right? You can see basically the same concepts being applied on 4 hours. So it'll be on a 4 hours time frame and then a 5 minutes. So if you want to take a look at that example specifically, right, go to the YouTube. I think we have a recording of all the sessions that we have here. So take a look at Aussie dollar, right? So you see the same concepts being applied. We talk about smaller time frame confirmations as well. So for this specifically, I want to go deeper into the entries and stop losses and how we can use the smaller time frame demand and supply, essentially doing the same thing, right, in order to find our entries. So for this itself, right, I will take a look at gold. So if you take a look at gold on the higher time frame, let me just remove all of this, right, and let's take a look at it from scratch. So if you take a look at it on the higher time frame, so as always, right, the higher time frame would be the ones that will be that will tell you whether if prices are sitting on a key level. So first thing first, we want to mark out the supply and demand areas. You can see that on the monthly time frame, there is a supply region over here, right? This is the supply area. How is this a supply region? Take a look at the wicks of the candles. You can see that the wicks itself, this is the last demand. So this is the monthly picture. So monthly just means that each candle represents movement within a month. So you can see that you have very clear movements over here, right? So there is less noise on the higher time frame. You can see that there is this demand over here. Price came in, reacted to the demand, and then it failed it. So it creates a valid supply. So this is the supply region. You see that currently prices are testing the supply. So this is one, right? And then what is causing this move up here? If you take a look at the weekly, if I do zoom out, you can see on the weekly, pretty much the same thing. We have supply. You can see supply, right? With represented by the wick of the candle over here. If you take a look take a look at it on the smaller time frame, you see the same thing as well. So there's supply, and then you can see the candle that's still held within the supply, this candle that we have over here. When supply fails, it creates demand, right? So you can see over here, this is the supply. Supply region, supply fails, creates a demand area. So this is the demand zone. So you can see that prices are sitting on a weekly demand area. It's testing a monthly supply region. So these are the two areas, right? And then if you go on to the daily time frame, this area here, right? So now that we have marked out the supply and demand areas on the daily and monthly region, if you take a look at this movement itself, right? So same thing, right? Recall what we mentioned about the move. So you can see that this caused the break in structure here. So this is the last low. Price came down and it broke below this low. So one of the supply regions that we can take will be the extreme of this move, which is basically this. You can see this candle over here. And within this area itself, you can see supply zones being respected as well. How so? You can see this candle. This is the last candle that we have, the extreme of the move. Price came in and mitigated into this supply region. And then it forms a new supply region that we have, which is the current one here. Okay, so I'll change this into a different color, right? Probably darken the border so that we can differentiate. Or maybe let me just change it to blue so that we can see it better. So you can see what happened here, right? So essentially it's the same idea, right? You can see even within the smaller time frame itself, there's demand noted by this wick of this candle, the last candle that we have, and then price came in, reacted to the demand before it failed it. You see this demand area here. So this is the last supply region. You can see price came and tapped into the supply area. So once price enters into this zone, right, this is when we want to focus our attention on the chart, when it enters into a key zone. So it's important that you don't just trade it off any random level itself, right? Look at the higher time frame. It has to enter a zone before we take any trades. So in this case, right, when price enters into this region, you can see the supply region over here. This is on the daily. You can go down to the smaller time frame, essentially try and find the same thing. So you can see that coming into this region, essentially coming into this supply area, you can see higher lows and higher highs being formed. So you can see higher lows and higher highs being formed. And this is the last low, right? So if I were to paint out the structure on the 30 minutes time frame, you can see very clear market structure here. So you can see the high, right? So this is the last high. So you want to mark out the last high that we have, which is this high. And this is the last low. So what this also shows is that as long as prices are in an uptrend, right, because we wouldn't know if we can see this reversal here, there's always a chance that price could go deeper into the region, right, into this daily supply region that we have, go above it before the change in structure. So basically what we need to do, it's having identified this area, you want to mark out the last high and low. So this is the last high that we have. You can see that spike, and this is the last low. What this also means is that as long as price holds within this region, right? If price doesn't break above this high, anything within this zone itself, it's what we call internal range liquidity. It's basically internal. There's no change in structure. Okay, so this is the last move. This is the last high that was being registered here. You can see this high represented by this wick, and this is the last low where price push into this area. You can see that if the uptrend was to continue, right, higher lows and higher highs being formed, recall. So in this case, the assumption is that price will continue forming higher lows and higher highs unless otherwise, right? So in this case, you can see that when price comes into this region, we have, so this also uses the concept of support resistance areas, right? So for those of you guys who are familiar with support resistance areas, that's one of them. But the idea is that basically you can see that price came into a supply region here, right? So this is the last high that we have marked out. So I'll just place this high over here. And one thing that's interesting to note on this is that for this, we will combine the concept of strong lows and strong highs and strong lows, as well as weak highs and weak lows. So in an uptrend, you can see that this low itself, as long as the low takes out a high, you can see the low, for example, it took out this high. So this low should not be violated. You can see this is a strong low because it took out the previous high. And then again, right now, this low itself, is this a strong low? No. Why? Because you can see it didn't break the high. You can see this region, right? So we have consecutive lower, higher lows that are being formed. If you mark out the lows, you can see consecutive higher lows being formed. But what's important is that it didn't break above this high. So what this suggests is that the lows themselves, if it doesn't break above a high, it will not be a strong low, right? It will be targeted. So that's the idea. So when you see this structure coming in, right, it's important to identify the structure first. This is also what you can term distribution. But the idea is that basically when price comes into an area and you see clear structure being formed, we expect price to continue to form your higher lows and higher highs. In this case, right, if the low is formed and it fails to break the high, then what this suggests is that this low itself would be weak, and we can place shorts, right, in line with the higher time frame. It has to be in line with the higher time frame. Recall that we're on a higher time frame supply, right? This is a daily supply that we have, and this gray zone that we have is the monthly supply. So it has to be in line with the higher time frame. Then that's when we wait for confirmation on the smaller picture. Now, so having said this, right, so we have identified the structure. We take a look at this area, right? So this is the last low. So let me just mark out the highs and lows. Right, so I'm just explaining the thought process behind this. Of course, this is on hindsight. So the next question to ask ourselves is that how do we know if this low itself is going to be weak or strong? So we'll come to that in a while, right? So this area, so you can see this area. So you have structure over here. Price failed to break the high. You can see that it came into what you can also call a resistance area or supply region. So price acknowledges the daily region first, which is this blue zone. Push lower, form your new structure, form a new low, but fail to put in a new high. And then how do we know that this low is weak, or how do we know when to play the shorts? It's when on the smaller picture, right, price comes into this resistance area and it starts showing signs of reversal on the smaller time frame. So we're on the 30 minutes right now. You can go down to the 5 minutes time frame and you see basically the same thing happening. So with that, right, so now that we have that hypothesis in mind, right, let's just focus on this portion. So coming into this resistance area over here, right, we want to go down to the smaller time frame. Okay, I have a question by Chong, right? When it couldn't make higher high, does the market structure shift to target demand zone just as nature as the opposite scenario when it couldn't make a lower low but target supply zone? Is it the underlying psychology of buy long, sell short? Exactly, right? So yes, I think you got it, Chong. So essentially, right, that's the idea. When prices are forming higher lows and higher highs, right? So coming into this region, you can see new structure being put in place. So when you have market, right? So the assumption is that, again, the assumption is that the trend should continue in an uptrend, so it should continue putting in higher lows and higher highs. So once you have a structure being formed over here and price comes into a resistance area or a supply region, and on the smaller time frame, you can see reversal starting to happen. So we will go down to the 5 minutes for this later on. But the idea is that on the smaller time frame, once you see reversal starting to happen, what this suggests over here is that this high itself failed to put in a new low. This low itself fails to put in a new high. Right? Because it should continue putting in your higher lows and higher highs. But once you see that supply starts gaining control on this high itself, it shows that this low is weak. Hence, we can take the shots, playing this as the target. But what I want to emphasize over here is that it has to be in line with the higher time frame. So you cannot be going down to the 15 minutes time frame, the 10 minutes, and just taking any random structure over here. Notice that this only works because we are on the higher time frame. We're on the daily supply region. So you are taking this hypothesis, you're playing it aligned with this higher time frame, which is this daily supply. So the idea over here is that on the daily, right, we could see a reversal, and you want to go down to the smaller time frame, which is the M15, or in this case, the M30 minutes, identify the clear structure. So let me just remove all of this, right? So identify the clear structure, note the last high and low, right? So if this is the last low that's being formed, price came into a resistance or supply region, you want to check on the smaller time frame. If supply starts gaining control, what this tells you is that this low itself did not didn't do its job, right? And putting in a new high, it's a weak low. We can play the shots targeting this low. Whether it will go beyond or not, we wouldn't know, right? But what we can know is that this low itself can be a potential target, and it's aligned with the higher time frame. Okay, so I hope that this is clear, right? Because this is actually useful in helping you to determine order flow. You can take a look at this, right? It's just general price action. It can be applied across any time frame and across any charts as well. So in this case, right, so having identified this, now let's zoom down to the smaller time frame. So having understand this, right, the idea that price, when supply starts gaining control over here in this region, it tells us that we can target this as a low, and more importantly, it's aligned with the higher time frame. So let's focus on this portion of the chart now. Okay, so you can see price coming into this supply region, coming into this resistance area over here. So same thing, we go down to the smaller time frame. So I'll put a marker here, right? So focus on this portion of the chart. What we're trying to see here on the, on the smaller time frame, it's that supply should be gaining control. It can be in terms of the failure or change in structure on your smaller picture. So you can see coming into this region, right? So I'll go down to the 5 minutes time frame. So this is how you can keep very tight stop losses, right, and entries. So on the 5 minutes time frame, you can see again, right, again, based on fractal nature of the markets, you can see this same pattern occurring. So prices is reaching this resistance area, right? It's approaching a resistance area. You can see that coming into this region. So let me just remove the M30 markings. You can see that coming into this resistance area, what do we have here? You have again higher lows and higher highs being formed. So this is the fractal nature of markets. You can see higher lows and higher highs being formed. Let me just trace it out properly. You can see this, right? So it's the same idea, higher lows and higher highs being formed. What is the assumption? The assumption is that price should continue forming a higher lows and higher highs until there is a change in structure. When there is a change in structure over here, which is basically the break of the low, right? So when price breaks the low, what this suggests is that it's in line with the higher time frame. Recall on the M30, we're trying to see if this low itself, it's putting in a new high, right? If this low itself fails to put in a new high, and how do we know that? We know that by looking at the smaller time frame, the 5 minutes, right? So if we see that there's a change in structure on the 5 minutes, what this suggests on the M30 minutes is that this would be our target because this low fails to put in a new high, right? So recall the M30 structure that we saw earlier. So right now we're on the 5 minutes time frame. You can see the same thing happening again. So this is the fractal nature of markets. So essentially what you're seeing on the 5 minutes, the reversal will happen first on the 5 minutes and then on the 30 minutes and then on the higher time frame essentially. So if we want to see a reversal on the daily, it should first be reflected on the 5 minutes, right? On the smaller time frame. The smallest one would always show the reversal first. So on this time frame itself, you can see here, right? What is the last low that we have? This is the last low that's being formed. So if you take a look at it again, higher lows and higher highs, you can see this move. This is the last low that was being formed. Where would the confirmation of a downtrend be? When price breaks this low. You can see this area, right? So this is the last low. If you take a look at it in line chart, okay, maybe not so much in line chart, but you can paint the overall structure. You can see the overall moves here, right? So even if you paint it in line chart, candlestick chart, the idea is that you can see here, essentially, this is the last low. You can call it supply region, demand area, support area, right? But the idea is basically the same, right? Different terms being used, but you can see the structure that's being formed here. This is the last low. Again, assumption is that if price were to drive deeper, because we wouldn't know when is the reversal, right? Price could always go deeper into the region. So if price were to continue deeper into the region, it should form your higher lows and higher highs. In this case, this is the last structure. You can do the same thing again, go down to the 1 minute time frame, check for reversal, because if there's a reversal on the smaller time frame, then it suggests that this 5 minutes, this low itself, it's not going to hold. Or if you don't want to go down to the smaller picture, right? So if 1 minute is too choppy for you, you can just wait for a break in structure here. This is the last low. Once price breaks below the last low, it shows you that there's a change in market structure. It also shows you that, so what this shows you on the 30 minutes, right? So recall we were asking the question, how do we know if this low it's going to hold? How do we know if prices are not going to move higher? When there is a change in structure on the 5 minutes time frame. And what this shows you over here, right, is, and how do we know that there is a change in structure? It's when price breaks this low. So when price breaks this low, right, this can be in terms of a breakout retest strategy, right, a break of the support region. But the idea is that when price breaks this low, what this suggests is that this 30 minutes itself, it's a weak low, right, because it fails to form a new high. It's a weak low, hence we can play the shorts. What is even more interesting, right, because we're on the 30 minutes, right, recall back then when we saw the 30 minutes, you can see on the 30 minutes, same thing, fractal nature of markets, right? So this is the 30 minutes low. When price breaks below the 30 minutes low, you can see here, it then retested this region as a resistance before continuing on the downside. And how so, right? Because the 30 minutes low, it's basically the confirmation that we have that we are using, right, for the daily picture. Recall we have a daily here, the daily supply region, right? So it's always the same idea. The question that we ask ourselves, right? How do we know if this supply region is going to hold? How do we know that this blue zone that we have over here, this daily supply region that we've identified, it's going to hold? We can look at it by looking at the 30 minutes time frame, right? So on the 30 minutes time frame, we saw that there is structure. So we identified structure by looking at the last high and last low that's being formed. And you can see that this is the last low that's being formed. We wouldn't know whether this low is going to hold, right? Because price could always continue to form your higher lows and higher highs since it's in an uptrend. You see higher lows and higher highs being formed. So how do we know that this structure or this low will be weak and targeted? We go down to the 5 minutes time frame and look for the same thing, right? So because if you are on the 5 minutes time frame, you can see that this move up on the 5 minutes. Let me just highlight this in a different color. This move up on the 5 minutes, this blue movement that I've highlighted, this move up on the 5 minutes, it's basically showing you bullish market structure until there is a change in structure. So let me just go back, right? So you can see here, right, this blue movement that we have, the 30 minutes impulsive move that we have over here, right? This impulse move that we have over here, you can see on the 30 minutes, right? On the 5 minutes, right? Same thing, the reversal comes here when there is a change or the break in market structure on the 5 minutes. So once there is a change in market structure, what this shows you is that on the 30 minutes, right, this low can be our target. So you can easily take the shorts here, right? Understanding order flow, understanding that you're on a higher time frame supply, and more importantly, the smaller time frame is giving you confirmation with the change in structure. Okay, so in terms of the trading strategies, right, there are a few ways. If you want to be extremely precise in the movement, right? So either you can wait for the 5 minutes change in structure, which in this case will be the break of this low, because this is the last low that we have. You can see here, right, the break of this low. This low, right? A breakout retest strategy here. Entry over here. So where would the stop loss be, right? If you have an entry over here, the stop loss, right? So realistically, you can see that this is the structure. So when price breaks below the low, recall that in a bearish trend, we are expecting the highs to hold, right? So in the earlier part of the session, we mentioned that in a downtrend, we're expecting prices to hold, which means that you can place a stop loss anywhere above this high, understanding that if price continue like this, right? If it pushes above it, then we're wrong. We want to get out of the position. So stop loss are meant to be in an area where if you're wrong on this trade, right, you're wrong on this hypothesis, you want to get out of this trade. Okay, so stop loss can be above this high over here, right? And the target will be this M30 low. This M30 low, this low that we have marked out, this low over here. Of course, in this example, prices went way beyond it because it's sitting on a higher time frame supply. You can see it went way beyond the M30. We tested the M30 region as a resistance, right? So if you are familiar with the concept of support and resistance areas, then this would be a resistance area before it continued to the downside. But what I really wanted to show from this example is understanding order flow, right? Understanding that on the higher time frame, how do you look at the smaller time frame for confirmations and play in the direction of the higher time frame? So in this example, you can see over here, right? So let's focus on this. So you can see that this is the 5 minutes. So there is a 5 minute structure that's being formed. So if you want to go down to the smaller time frame, right? This is basically the low. You can see here, this is the last low. Ask yourself the same question, right? So for those of you guys who are curious on where you can get 1 minute or 3 minutes entries, right? This is how you can take a look at it. So this is the last low that's being formed. So ask yourself the same question. How do you know if this low is going to hold? This low, how do you know if this low is going to fail? right? Because we are looking at a bearish structure here. We're trying to sell because prices are on a higher time frame. It's on the daily supply region, right? We call the blue zone that we have. It's on the daily supply region. You're waiting for smaller time frame confirmations, which is basically bearish. You're trying to wait for bearish movements. So this is done by identifying the last low and asking yourself if this low is going to hold. So if this low it's going to hold or not, right? I need to check the smaller time frame. So again, when price comes into a resistance area or the supply region, so this is where you can take a look at the extreme of this candle as well. So this is the last candle on the 5 minutes. You can see this candle, the last candle here. This acts as a supply region. So I'll just put it in a different color. Let me just put it in, let's say, pink, right? So when price comes into a supply region over here, right, it's the same question, right? So are there any change in structure on the smaller time frame? Because if there is a reversal on a 1 minute time frame, what this suggests is that this low itself, it's weak. Why is it weak? Because it fails to put a new high, right? Because in an uptrend, prices should continue to form higher lows and higher highs. If it comes into a supply region and it starts respecting the supply region, it tells you that this low, it's a weak target and it's in line with the higher time frame order flow, which is bearish, right? Because this low failed to put a new high, hence that's why it's bearish. Okay, so I hope this thought process is useful, and also more importantly, it helps you to take a look clearly at how you can combine the different time frames by looking at market structure, order flow, and understanding different time frames. So this is basically an example on gold, right? So yeah, so we take a look at gold, right? So looking at the different time frames, combining your monthly, your daily, right? So monthly is the gray zone that we found. The daily is the blue zone that you have over here, right? So the blue zone that we have on the higher time frame. And then we also went down to the smaller time frame to basically explain how we can confirm it on the M30 and then again on the M5. So you see basically the same patterns repeating themselves over and over again. Okay. Okay, I have a question by Chong, right? I'm so sorry if it's implying that sell long, it's still riskier than buy long for more assets, even commodities. Sorry, Chong, I don't really get your question. So basically, right, look at the market structure, understanding weak highs and weak lows, right? Using that, is that what you're trying to ask? Okay, so maybe you want to put the question down again, right? Yes, Sarah, this is recorded. So you can actually find this on YouTube, right? So all the sessions are recorded. So we do have sessions on a daily basis. I'm covering mainly on Wednesdays, Thursdays, and Fridays, and the sessions are recorded. So you can actually use this, right? So if you find this session helpful in terms of the thought process and all that, right, you can actually review them again on YouTube. Okay, so I ran slightly over time, right? So the next concept that I want to cover, it's more on risk and trade management, right? So the idea is that in general, when we take any of the setups, so okay, so back, let me just maybe review this slightly. So I talk about entry, stop losses, and take profit, right? In this example, I covered on breakout strategy, right? So in this case, it really depends on where you want to enter. If you want to go down to the smaller time frame, you can on a 1 minute time frame, look for the same reversal, understanding that this low itself, right? If we see reversal on the 1 minute, for example, then this low, what it implies is that this 5 minutes low is weak and it's in line. It's a line, right? We can see a break in structure. So if you want to wait for more confirmation, wait for a break of the 5 minutes low, which is in this example, in this case, right? You can put an entry over here based on a breakout and a close, right? A retest as a resistance. Stop loss covering the high, understanding that this is the last high that broke structure. So we should not be expecting price to come back and retest this level. We shouldn't have a case where prices are breaking above this high, because if it is breaking above this high, we are wrong. We want to get out of the position. Okay, so in terms of the risk, right, generally 0.25% to 2% per trade. And then I also want to cover on the idea of risk to reward concepts, right? So risk to reward concept itself, right? So basically for those of you guys who are not familiar with risk to reward concept, the idea is that for every dollar that you risk, right? So let's say if your risk to reward ratio, it's 1:3, which means that for every dollar that you risk, you get $3 in return when it hits your take profit target. So of course with this, right, the higher the risk to reward ratio, the better it is, right? So there's a way you can measure your risk to reward, right? So what you can do is using this tool over here. So let me just remove all of this so that it's not as cluttered, right? Let me just take this example. So let's say if you have an entry over here, stop loss covering this high, right? Understanding that this is the last high. So you want to put it just slightly above this high, with the idea that because this is the high that took out the low, you can see that this high broke structure, it broke the last low, right? And you have the 30 minutes target. So I'm still using the same setup on Go, right? I just remove all this marking so that we can see this movement clearer. So if this is your entry, your stop loss covering the high, your target here, what you can do in terms of the risk to reward, measuring the risk to reward, it's using this tool here on TradingView. So you can say, take a look at it. If we're looking to sell, right, because it's aligned with the higher time frame order flow, right? Recall we're on the daily we're on the daily supply, right? So previously we have this dark blue zone, we're on the daily supply. So if you have entry, if you have your entry over here, right, stop loss slightly above, covering the high, take profit here, you can see that the risk to reward ratio for this is at 2.79. So 2.79 means that for every dollar that you risk, if it hits your take profit target, you get 2.79 times. Okay, so this is basically what risk to reward ratio means. So understand that when you're on the smaller time frame, because you're able to keep your ratio much tighter, right? So if my entry is on the 5 minutes based on this breakout covering the high, targeting the M30 time frame, you can see that the risk to reward ratio is 2.79. But if you're on the higher time frame, so let's say if you're on the M15 minutes time frame, you can see that this ratio, right, on the M15 minutes time frame, the break in structure, your confirmation comes over here because this is basically the last low. You need to wait for a break of the last low, right? If you're on the M15, this is your confirmation. You can see that if you take a trade over here, your stop loss, right? So this is basically the move down. You can see a break and retest of it again. So it's the same thing, right? Breakout strat, breakout and a retest of it. But you can see that the high itself is now here. So what this also shows you is that if you were to take an entry of the M15 minutes, you can see that your entry would now be this area. Your stop loss will be covering this high. Your profit target itself will be on the low, right? Covering the next support area. You can see the risk to reward ratio is not as fantastic, right? This is about only 1.07 risk to reward ratio. So in this case itself, right, what's interesting to note is that if your entry is on a smaller time frame, so let's say on the 5 minutes, the 10 minutes, right, the idea is that if you're on a smaller time frame, you're able to keep your stop losses much tighter. And because of that, right, when your stop losses are tight, in general, you will get much higher risk to reward ratio. Of course, this will also be dependent on your analysis, right? Because when stop losses are tight, you can have higher chance of it hitting your stop loss. And in that case, right, there'll be more, basically a lower win rate. So this will be dependent on your analysis, but the thought process is the same, right? So combining the different time frame and understanding basically where prices might be heading. Of course, this is not 100% accurate, right? We trade according to what the market tells us. There's also a case where there's a change in structure or break in structure, and then we see prices going against us. So this is why stop losses are important. Right, so we covered on the point on how smaller time frame can give you tighter risk to reward ratios. I mean, higher risk to reward ratios. We also talk about, okay, so in this case, right, I also want to share a bit more on taking partials. So even though we have a target, right, so let's say over here, in the same example, right, using the same M30, the Go example that we covered. So assuming that you have identified this low as a weak low and a potential target, right, you want to consider that because you're on the higher time frame on the daily, recall that we're on the daily supply region. Let me just move back, right? So recall that we're on the daily supply region, this daily supply zone over here, right? So price came and tapped into a daily supply zone. So what this suggests over here is that you could play on the daily time frame. You could have a daily target, which is this low over here. So let's say this, just looking at graphical level. So this was a previous resistance level, a huge resistance where we could see price come and test this region. So even though you want to have a higher time frame target, so let's say this is your daily target, understand that on the 30 minutes time frame, so in terms of trade management, so this one has to be more related to trade management. You can see that this area, right, we identified this as a weak low and a potential target. So coming into this region, when price reaches this region, right, what you want to consider is first closing a portion of the position, especially if you have secured a good risk to reward ratio. You want to close maybe just 20%, 25%. So this is up to your own preference. But the idea is that you want to close a portion of the position over here, because of course, on hindsight, I would say that I will hold it all the way, right? But in actual trading, trade management wise, it's extremely important. You want to make sure that if you're in a profit, you want to protect it or trail your stop losses in a case where there is a news event, unexpected data release, right? Or even interest rate decisions or some Fed comments, for example, that could cause a huge spike against us. So this is why trade management is extremely important, right? So understand that when price goes in your favor and it reaches a key level, right? So this hypothesis, right? Recall that this is the low that we have over here. So if it reaches a key level, what you want to do is to ensure that you take a portion of the position, right? Close partials, and also, yeah, so just shift your stop loss to break even. That's also something, right? So essentially removing any risk that you have from holding the position, it also allows you to compound. And then finally, we also talk about understanding order flow, right? So if there are any structures target on the 5 minutes, the 15 minutes. So we saw this clearly in this Go example. Okay, so we've come to the end of the session, right? So this is just a summary of it. So in this case, right? Oh, sorry. Okay, I have a question, right, by Trong. I got, you said earlier, from when sell, do a short. So wonder if even with commodity, sell long is riskier. Yes, so in general, right, it's the same thing, right? So even with commodities, you can apply the same concept, looking at market structure, understanding if prices are on a key area. So if prices are on a key supply region, right, wait for price to go to the smaller time frame. So let's say if you're on commodities, right? So gold itself is also a commodities actually. So it's the same idea, right? So essentially when price comes into a region, and yeah, pretty much the same thing that we've showed earlier. Okay, so sell long, it's riskier, right? So when prices, so in general, right, if you want to wait for a higher time frames confirmation, you can wait for the 15 minutes, right? Wait for a change in structure or a break below the low to be aligned with your higher time frames direction. Okay, so I hope that answers your question, Trong. Right? You're very welcome, Sarah, right? I'm very glad that this is very helpful. So yes, this helps me a lot in my trading as well, right? So in terms of the process and understanding, this is basically just understanding price action, understanding order flow. So map out the zones, right? Supply demand areas on the higher time frame, and then use the same thought process, right, to help you to understand whether a high is actually weak or strong, right? And then if in general, right? So the idea is that if you're looking to sell on the higher time frame, you need to identify lows, right? Or basically lows that are weak, and then you are targeting them. Okay, so yeah, I'm glad that you find this session very helpful. Okay, so yeah, this is basically a summary of what we've covered so far. We take a look at market structure. We covered on uptrends, downtrends, as well as trends moving sideways, right? Understanding the concept of weak highs, strong highs, weak lows, and strong lows. The idea is very simple, but you can see how this idea itself actually helps in terms of understanding where prices might be heading. Of course, it is not going to be 100% accurate, right? We always trade according to what the market tells us, right? So there's no expectations, but you can go there with a hypothesis and then test it on the smaller time frames. We also talk about supply demand areas, right? Trying to determine if this and looking at stop losses, entries, and take profit targets. You see in these examples that if you enter on the smaller time frames in general, right, using the same thought process, right, nothing much change, right? It's the same thing, but applied on the smaller time frame, you can keep tighter stop losses, and then because of that, right, you're able to give higher risk to reward ratio. But I do want to highlight that with smaller time frames, right, because of the noise itself, right, it can be a bit more choppy. So yeah, we talk about supply demand areas as well. We saw this example and how we can apply in details on Go, right? We take a look at the risk and trade management. So ideally, we want to risk less than 2% on each trade and understand the concept of risk to reward ratio. We covered on partials, taking partials, right? So it's extremely important, right? So trading strategy is just one of them, right? What's more important, that's basically the trade management. So how do we manage this when they're in profits? Okay, so I hope this session has been very helpful. And if you guys like any of this, right, we do actually have a review of this at the end of every month. So we will highlight specific setups, go deep into details as to why we take the setups, the thought process behind them. So we're trying to hold a price action trading masterclass at the end of every month. So if you guys like this session, right, and I'm glad that some of you guys actually, yeah, you guys find this helpful. We have a lot of questions coming in as well, so it's great, right? So if you guys have any more of this, right, if you have preference for this session, right, do put them under the chat box. And yeah, we will try to hold more of the sessions. Okay, so we have come to the end of the session. I'm so sorry that this dragged on, right? It's supposed to be a shorter session, but yeah, I'm glad that we have so many questions coming in. It shows that you guys are actually internalizing this content. Okay, so yeah, so thanks everyone, right? Have a great weekend. For those of you guys who want to review a recording of the session in terms of the thought process and all of the stuff and examples as to how we apply these concepts, they're very simple concepts, but you can see how all of them come together in this example for Go, right? So if you do want to review this, they will be posted on YouTube. So you can just go to Vantage YouTube page, right? You should see all the sessions being recorded. Okay, so yeah, thanks everyone. Stay safe, right? Trade safe. We'll catch you guys again next week.